This is the story of the world's biggest bankruptcy.
This has truly been a manic Monday on Wall Street.
It was the worst day on Wall Street since the crash of 1987.
Stakes were high.
Hank Paulson didn't think he signed up for this when President Bush picked him to become Treasury Secretary.
So the leader emerged.
He was named by Forbes as one of the top 10 executives in the country. They called him the gorilla.
Well, this man gives the word denial entirely new meaning.
Promises were made.
Every one of you should feel confident and proud. Our firm is strong today, and we will emerge from this cycle even stronger. We've done it before, and we will do it again.
But when greed takes over, words mean nothing.
This week alone, Lehman Brothers stock plummeted almost 80%.
You have Lehman Brothers filing for bankruptcy.
Lehman Brothers is going bankrupt.
And sometimes, a simple lie can affect many lives.
Lehman, which has 25,000 employees, will be liquidated.
I don't think anyone really expected a bank as big as Lehman to be in a position that it's in now.
But it was just the beginning of a fall.
There's Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%.
A fall that destroyed multiple economies.
What started in America last year has now spread to every part of the world.
The Paris market down by 9%. Austria, which was briefly suspended earlier on in the day, is down by nearly 11%.
Confidence is a very fragile thing, and in our financial markets, it is eroding very quickly.
The story begins in 1844, when Henry Lehman opened a dry goods store in Montgomery, Alabama. By 1850, his two immigrant brothers joined him, and this small store became the Lehman Brothers. It was the time when the cotton market was booming, so they started cotton trading. However, when the Civil War erupted, the center of cotton trading shifted from the South to New York City. As a result, they moved their operations to New York City, where they expanded into commodities trading. The firm was so successful that it helped found the New York Cotton Exchange, where Emanuel sat on the Board of Governors until 1884. In the following years, they diversified into various ventures, moving from cotton to coffee, and eventually into railroad bonds. However, the most significant shift occurred in 1887, when the firm became a member of the New York Stock Exchange. By the late 19th century, they evolved into a full-service investment bank. They faced numerous economic storms, including the Civil War, the Great Depression, and 2 world wars. In 1984, American Express acquired Lehman Brothers for $360 million. They spent the next decade as part of the company's investment banking division until they were spun off into their own publicly traded company in 1994. And this was the time when a lifelong employee, Richard Fuld, was appointed as CEO.
Dick Fuld was driven and good at what he did. Very good.
A person who was viewed as a lion on Wall Street.
Fuld wanted Lehman Brothers to reach the top of the banking world, and his strategy was to kill the competition.
Lehman Brothers will eventually inherit the heritage and the tradition that will let it stand alone and conquer all the people that stand in front of us. That's what I want Lehman Brothers to be. Basically to crush our enemies like this.
Under Fuld's leadership, the company adopted a high-leverage strategy, which means they borrowed a ton of debt to fund the company's operations and investments. By investing larger amounts than their competitors, they were able to generate higher revenues. During Fuld's tenure, Lehman's revenues soared by 600%. Rising from $2.7 billion in 1994 to $19.2 billion in 2006. His strategy was so successful that he became the longest-serving CEO on Wall Street and expanded Lehman Brothers to the rest of Europe. As a result, the company became the 4th largest investment bank of the United States. And this is where things messed up. In the early 2000s, the real estate market in the US and around the world was booming. This was because of low interest rates and a lot of incentives from the government.
Good morning. Owning a home lies at the heart of the American dream. A home is a foundation for families and a source of stability for communities. It serves as the foundation of many Americans' financial security.
The US government was prompting people to get homes, and investment banks were providing loans. It was a simple practice, but what if a bank started giving loans to people who couldn't afford that loan? We are talking about subprime mortgage, which means mortgages to people with low credit scores. But why would someone do this? Actually, there were two solid reasons. First, in subprime mortgages, interest rates are slightly higher than normal mortgage loans, which means banks can earn a better revenue. And secondly, even if borrowers ended up not paying back their mortgage, banks could just take back the house and resell it right away since there was so much demand. For years, this practice became a solid money-making formula for all banks, and investment firms like Lehman bought thousands of mortgages from smaller banks, bundled them together, and sold them as mortgage-backed securities to investors.
As the housing market heated up, there were asset management firms around the world that all wanted a way to benefit.
Now, this greed led Lehman Brothers to own more and more real estate. At one point, the company had $639 billion in assets, but only $7 billion in cash. Everything was great. The company's shares were soaring with an all-time high of $86 per share. But then, something unexpected happened. In 2007, interest rates went up, which means now you have to pay more interest on your mortgage. So, the reason which was fueling the American dream of a good home was no longer there. As a result, the demand for houses declined suddenly. Additionally, people who had already taken a subprime mortgage were forced to pay their loan at an increased interest rate. In simple words, people with no job, no assets, and no money were forced to pay an increased amount, which led them to foreclose. It was like a checkmate for investment banks because people were not paying their loans and no one was buying their foreclosed houses. 2008 started with the collapse of one of the most prominent investment banks, Bear Stearns. But the Federal Reserve helped, and somehow they were eventually bought out by JP Morgan. This was a clear danger for all the investment banks, but even at this point, no one took any safety measures. By September 2008, Lehman reported a third-quarter loss of almost $3.9 billion. Its stock experienced a free fall, dropping from $84 per share to just $7 per share. The only hope was that the Federal Reserve would do something, but this never happened.
I never once considered that it was appropriate to put taxpayer money on the line in resolving Lehman Brothers.
But after all, it was the fourth largest bank of the US, which means it was too big to fail. So the federal government couldn't just let it collapse, and that's why Bank of America showed interest to buy Lehman Brothers. But it was already too late, and now all the investment banks were facing the same threat. The only difference was that Lehman Brothers was sunk too deep with subprime mortgages, and that's why Bank of America decided to help Merrill Lynch instead of Lehman Brothers.
One bank that refused to get involved is Bank of America. It wouldn't step into the Lehman Brothers situation. That's when the government suggested Bank of America look into buying Merrill Lynch and Company. And that's just what's happening. The Charlotte, North Carolina-based bank will acquire Merrill Lynch in an all-stock transaction worth about $50 billion. The transaction is expected to close in the first quarter of next year.
They were left hopeless, which led them to file for bankruptcy.
Sunday, Lehman Brothers made the largest bankruptcy filing in American history.
And this collapse affected the entire economy. When a 148-year-old firm fails, it creates a domino effect. All economic institutions were in a panic because they knew they could be the next.
Now, you see how the fire spreads from one company to the next company. And then everybody looks and says, ooh.
Everyone was calling their bankers to withdraw everything.
I describe it as an economic Pearl Harbor.
And some of the biggest institutions were lacking enough cash to run their day-to-day operations.
A day after the failure of Lehman Brothers and the fire sale of Merrill Lynch, attention turned to AIG.
The world's largest insurance company, American International Group, is seeking emergency funding as it struggles to stay afloat.
So, a single investment bank crashed the whole economy, which led to the worldwide recession of 2008. Some blame Richard Fuld for his aggressive approach.
Your company is now bankrupt, our economy is in a state of crisis, but you get to keep $480 million. I have a very basic question for you. Is this fair?
Some blame the federal government itself.
Lehman was a massive mistake. And I think maybe those who were involved in that decision will still defend it, but I think when you look at the tremors afterwards, I think that goes down as one of the most colossal mistakes ever.
But no matter who was the villain here, casualties were faced by normal people. Lehman's fall is a perfect example of how negligence and taking too many risks can lead to the collapse of even the biggest financial institutions. Now, if you think that that was one of the most shocking stories of financial failure, don't miss our video on Jordan Belfort. Discover how a meat salesman managed to scam an entire country and become the Wolf of Wall Street.